Good morning, everybody. It is November 1st, 2019. I'm Kirk Spano, and we have a lot to talk about today. So I'm going to start with something off topic. I went to see Hamilton last night in Milwaukee. Haven't seen it before. Had no idea what to expect. My girlfriend was able to score first row tickets in the balcony for $100 each. And in hindsight, I will say that might have been one of the biggest bargains that I've gotten in a while. If you haven't seen Hamilton, honestly, I probably sat there for the first 10 minutes with my mouth open. I didn't realize really what it was. I had never watched a preview online. And, I've been to Broadway shows, so I knew it'd be musical. I just didn't expect it to be quite as entertaining and tell the story quite so well of Alexander Hamilton, whom I read the Federalist Papers twice in my life, cover to cover. And you can tell when Hamilton is writing versus John Jay or good grief, I'm stuck. But you could tell when it switches to Hamilton. He wrote about 2/3 of the Federalist Papers. And if you haven't seen it, it's in your city. I will tell you, the cast blew my mind. They were so good that you wouldn't know that it wasn't, the New York production. So, except I'm sure if you've seen the New York production a few times, you probably know some of the cast. But these folks were amazing. James Madison, yeah, sorry about that. And it got me thinking. One, they used the phrase several times about how Hamilton wrote like he was running out of time. And this year, I have not been that guy. So keep that in mind in coming weeks. Second, they talk about not wanting to miss your shot. And I think that as investors, we are all getting a chance right now to have a shot. And I think we're going to get a couple of shots, but we have to think about it incrementally. I think we have to think about it first off as playing defense, staying protected, like Aaron Burr maybe. And ultimately, we're going to have to put some chips in on some things that can outperform over the next several years. And while we've been very conservative this year, grinding out probably, if you guys are where I'm at, you've ground out a high single-digit return this year by selling some puts and focusing on, some of these value plays that we've gotten into that pay the big dividends. I wouldn't expect anybody's made double digits. If you have, you've traded really well or taken some risks that worked out. I don't think anybody should be down this year unless you looked into the headlights and froze. But we have done relatively well. Upper single digits is about where most of my accounts are at. And that's even with sitting very heavy in cash, 30-ish% earlier in the year and 60-ish% now. So if you haven't seen Hamilton, go see it and think about some of the things they talk about, reflect on it a little bit, and see if maybe there's a little motivation in there for you in the way that you think, act, talk, behave, anything. I think that it was actually, out of the 15 or so Broadway shows that I've seen now, it's right there at the top. So now I have not seen Book of Mormon, and I'm dying to see that. I don't know that it's exactly the same type of message, but yeah, I just thought I'd start out with that today before we get into some of the economic numbers, which we're going to fly through. So U.S. consumer spending is holding firm. Jobless claims were a little bit concerning yesterday, but then the employment report came out today, and it was ahead of expectations. The problem is that the expectations were low. So really what we're seeing here, and we talked about this a while back, is that most of the economic numbers are flattening out. So Ray Dalio gave an interview in the last week or so, and I think it's on Bloomberg, if I remember correctly. But if you get a chance to see it, he talks about a lot of the things that I've been bringing up, which is we're just starting to run into a lot of significant economic problems that are going to cause choppiness in the market until there is a dislocation. I don't know that I can find it, but I'll put it on the blog or something for you to watch. He's essentially saying the same things I'm saying. I'm sure he said them first, and he has more credibility than I do. But the slow growth forever, the structural challenges that we face, the potential solutions, they're all very similar things that he's saying to what I've been saying. Now, that doesn't make us right. I'm just some guy in Milwaukee who tries to figure things out, and he's one of the richest guys in the world, hedge fund manager who's really created some things that should have value to you. Now, let's see, is this the right link? Yeah, it is. It's the David Rubenstein one. This is the one. Yeah, the one with David Rubenstein. So it was the David Rubenstein show. If you get a chance, watch this and tell me if it echoes some of the things that I've been saying or a lot of the things I've been saying. It's important because the context to which we look at investing has to play into the economy and the likelihood that we're going to see some dislocations, some choppiness, and some problems that have to be addressed. And then we have to try to figure out how will those problems be addressed and in what time frame. And ultimately, we know that all broken things get fixed. That's just the nature of things. It's the nature of humanity. And some of the nature of humanity, again, go back to Hamilton. Some of these things just hit you in the head all at once. I wanted to go out and have a bottle of wine afterwards last night, and I've got plantar fasciitis, so I was just in so much pain I decided to come home. But we really need context for everything that we do, and I bring this up repeatedly because there's a lot of people who are starting to chase returns right now, and I see the type of behavior today that I saw a decade ago or 11, 12 years ago now. And it's not going to end well. So folks who are chasing performance right now, people who are piling in the high dividend yielding stocks at 7, 6, 8%, without looking at what their earnings are, without looking at what their real growth rates are, without looking at what their leverage is, but they just see that 7, 8, 9%, and they're like, oh, that's a great return. Well, like a closed-end fund, a lot of high-yield stocks are really just returning principal to shareholders and or leveraging up debt. And in those cases, it can't last. So I just throw that out as a warning that I'm going to throw out over and over again in the next few months because I'm going to stick with my prediction that once we get somewhere into the first quarter next year, we probably have a rough rest of the year. All right. So the 2019 earnings scorecard, you can find similar things on CNBC or any other website. What we know is that it's been a pretty blah earnings season, right? So we have most companies, as usual, meeting expectations, but again, expectations were lowered. The stock market is still getting to all-time highs, chopping around all-time highs. Now, the all-time high today versus the all-time high in January of 2018, the difference is like 7% or something. It's a small difference. So we really haven't seen a giant rally here in the last 21 months. What we've seen is sideways movement with little nudges higher. And that is indicative of a topping process. So when we take a look at earnings and expectations keep flattening out or falling, but they meet expectations, at what point are the expectations wrong and they miss? Or at what point do they bring the expectations far enough down that the valuations in the 50 to 100 stocks that are holding the entire market up, do those fall apart? You're starting to see chinks in the armor right now, right? So Tesla is chopping around. But if you look at the bigger stocks, if you look at Amazon, you look at Google, right? You look at Apple, they're chopping around. You know, Apple's chopping around at highs, but Amazon and Google got little nicks. So when those giant stocks start to take too many nicks, it starts to create an avalanche of selling. Why? Because people get scared. So when the first sellers go, not that big of a deal. But then you get another wave of sellers, probably after some consolidation. And then you get another wave of sellers. What we need to avoid, right, otherwise we're going to see that 20 to 40% correction, is for those big companies to hold up. Well, we're going into an election season where both parties are saying, hey, maybe we need to do something about these big companies having too much power and too much money. So again, that's one of the legs of our stool is, you know, what is the impact of the government? And as we know, giant companies have a hard time growing unless they're part of an oligopoly or monopoly pricing power equation, in which case they draw the ire of regulators and government. So it's a cycle. You can go back decades and decades and see how consolidation drives earnings up, and then how more competition coming in either by entrepreneurship and or government lowers the earnings for those companies, but ends up probably being good for the economy and the consumer in the long run. So just be mindful of where earnings are and what companies are really holding up the stock market. And we know that somewhere around 90% of the gains in the stock market are those 50, or I forget what number it was exactly, but it's around 50 or 60 or 65 companies that account for all the gains out of 3,000 stocks, you know, in the Russell 3000. And that leaves us with really a dilemma. Do we just pile into those stocks, or do we look for value? And there are times where you want to pile into those stocks, but it's not at the end of the cycle. It's at the start of the cycle. So if we get that 20 to 40% correction that I'm talking about, it will primarily be in the big stocks that'll lose 20 to 40%. Other companies will lose way more. So we'll be able to find value in both places, in the big companies that everybody piles into via their index funds, and by some of these smaller and mid-size in particular, profitable companies that are at the cutting edges of the new economy that is developing. So where is some of these new economy stocks? Well, let's take a look at alternative energy. We're going to take a look at 5 or 6 stocks here at the end, but in general, the ideas behind alternative energy are all solid. And what we've had here in the past decade is a foundational period. We've been laying the groundwork for an alternative energy boom. And it could have happened sooner with more legislation encouraging it, but it's going to happen anyway because the technology has finally got there. So now we're in a situation where coal is under major stress in the United States, not so much in other places, but there are some government actions in the United States that could make coal unviable actually throughout the world. So I would expect that there's a good chance that happens soon. But let's just take a look at the organic picture. Solar energy is getting so cheap that American utilities are tearing down coal power plants in favor of alternatives. New batteries are coming online. We've been talking about that. Lithium supply is actually rising faster than lithium demand. Why? Because of the alternative types of batteries. Nickel and zinc and aluminum now, that's the newest announcement, are all proving to be viable battery solutions. So as we find battery technology and figure out ways to manufacture it on the cheap, which happens after a year or two, we're going to see a huge uptick in solar because the solar actually is cheap. It's just a matter of storing the energy, which is on the verge of being cheap. So if we already have solar panels that are highly efficient, right? I think like 4 times more efficient than 10 years ago, 400% more efficient. And batteries that are coming down in price and becoming more efficient, at what point does it just become the right thing to do for everybody as a matter of their own pocketbook? At what point do companies just say, it's cheaper for us to do this than that? At what point do homeowners go, gee whiz, if I bundle another $15,000 into my mortgage, I'm not going to have an energy bill forever? You know, at some point, we hit those numbers, and we're very, very, very close. We're not talking 10 or 15 or 20 years anymore. We're talking 1 or 2 or 3 or 4 years, 6 on the outside. So somewhere in the next 1 to 6 years, solar and alternative energy with battery storage is going to become so popular that the growth curves go off the charts. I would guess 2 to 3 years. A lot of things are lining up for 2021, 2022, 3, 4. And again, to build some context, why is this important? Again, you don't need to believe in climate change. However, the legislators generally do. The governments around the world do. China, India, they're bigger emitters of pollution than we are now, but not per capita. Imagine if they had the per capita pollution that we did, right? Americans pollute more than anybody else on the world, but there's only 300 million of us, 330 million of us, versus, you know, over 1 trillion in India and China. So coal and oil are clearly the targets for reducing CO2 emissions by fuel type. Gas will remain a transition fuel, but I don't see this expanding all that much. It's not going to take the place of oil and coal. By sector, electricity production is about 45%. Then transportation, another 20%. So if we can reduce emissions on transportation, say by 3/4, and on electricity production by 3/4, both of these are attainable in the next 20 to 30 years. All of a sudden, we've basically solved our emissions problem. We don't have to worry too much about manufacturing because commercial manufacturers are going to move towards alternative energy themselves anyway. Those big flat buildings are ideal for it. We already see it happening. Residential, that's going to move in that direction as well. So imagine if 3/4 of emissions are gone by somewhere in the middle of the century, 2040-ish, 2050-ish, and it's all replaced by alternative energy, mainly solar and batteries. How big is that investment opportunity? It's so big that it's really hard to measure. I'm going to point out California in particular. California is moving very fast into the alternative energy space, into alternative energy future. People say, wow, big deal, it's California. Well, that is 1/6 of the US economy. And if California was a nation, it would be about the 6th biggest economy on the planet, right there with Germany and India. So as the California economy goes and the standards get built in California, the rest of the United States typically follows on a little bit of a time delay. Interestingly, some northern states are doing pretty well with alternative energy already. New Jersey, weirdly to me, Michigan, Massachusetts, some other states are really kicking into high gear on this. Why? Because they want some of the manufacturing. New York, right? Tesla has that plant up in Buffalo, and they are, trying to figure out what to do with it to meet all of their employment targets to get all their tax breaks from the state for having moved there. They're meeting those standards, meeting those limits, and I believe they will continue to do so. And you have to remember there are some pretty rich people in Buffalo helping the game along. If you're from Buffalo, you understand. So if you haven't taken a look at Bloomberg New Energy, take a look at it. Bloomberg NEF. It's a great blog. It'll help you understand what's coming. So don't believe that coal's going away. Take the drive that I took through Pennsylvania and a little bit of West Virginia and Ohio and Indiana. Coal is going away quickly in the United States. And ultimately, we're going to have to help these people. There's about 1 million people who are directly involved in coal mining, from miners to staff and everything else. A smart politician would say, hey, we're going to get rid of coal, but you 1 million people who have to go through a transition because of that, we're going to help you financially. We're going to make sure you get job training, you don't lose your house, and your kids still get fed. If we were smart, if some politicians were smart, that's what they would say. If Hillary really wasn't disconnected from society, and I say that having met her a few times, she's brilliant, don't get me wrong, but she was disconnected because she just didn't understand the plight of working regular, for lack of a better word, people. And that made them hate her because they knew, unlike Bill, who could feel your pain, she didn't. And that's unfortunate. Somebody needs to feel the pain of these 1 million people who are going to be affected by coal mining going away. Donald Trump promised to keep coal mining around. You can't fight the math. So how do you help 1 million people? It's not really that tough. Create some sub-pay and training programs, extended unemployment, and it all works out. Most of these folks would have jobs given today's labor market, and as many boomers who are retiring as we know of, right, was it 10,000 a day or something? these people have jobs within 2 years, no sweat. So it's not like they'd be permanent welfare. I say that not as an advocate, because I think that's what's going to happen. So we should be prepared for it. More coal getting lost, more people who are going to be affected. One of the things that Ray Dalio talks about is how all these transitions affect people. Right? Go back to the American Revolution. People had a hard time choosing sides, right? The king or the new America, a free America. We have to choose how we're going to help our neighbors through transitions, where we're willing to put our dollars. Governments are going to push us in the direction of alternative energy. All this evidence that they look at, right? This is the EPA. Even the EPA understands where we're at. They don't talk about it much, but they understand. If you go to the EPA website, they see all this. It's going to drive the future. All right. Where will the future have to be forced? At least in the short run, probably Southeast Asia. Why? Because they are really using a lot of coal. What does that mean? We need to stop letting them get the coal. We have to stop exporting it to them. And we have to create financial situations where our allies can't use the banking system to do coal transactions. It's actually not difficult to do. A president can do it with executive order. I would expect that the next president would entertain those ideas. Renewables are growing quickly for energy. Coal and oil are going to start falling apart on transportation and generation. And then gas will follow down the road. It's going to be a long alternative energy transition. It's not going to happen quickly. It'll probably take the better part of 20, maybe even 30 years. Now, right now, we're getting a little bit of a pullback in our solar stocks, the solar stocks that we've been following. Why? Because China kind of has hit a lull. China's trying to retrench because of the trade war, because of demographics, because of bad debts. Ultimately, if they don't want to have massive healthcare spending, they have to go away from coal. And they've started in a couple of the big cities. But again, it's choppy. The choppiness in transition is what yields your opportunity. Wait for people to go, oh, see, it's not happening. And when the prices go down, you buy. Because we know that it's happening. We know the world's going to alternative energy. This is not a debate anymore. It's a question of how fast. So just as oil stocks are sell the rip stocks now versus buy the dips, right? I mean, we're going to be sellers on a rally in the early 2020s at some point. Alternative energy is the opposite. Alternative energy is buy the dips. Now, there's enough volatility in the short run that we can trade it a bit. Ultimately, these are going to be hockey stick style investments that have their gradual growth, and then boom, you'll have those 100% years. And that's what will happen. You take a look at any stock that has over 10 years gone up 1,000%, and it didn't all happen in a straight line. Chopped along for a while, and then boom. And we can show you some of those charts. So let's talk about some of the specific companies. I know that's what you like. Let's talk about Tesla because it's a battleground stock. My base position here is that Tesla will eventually go to 1,000. they're going to take a ton of market share from General Motors unless they merge with General Motors. I don't know if it's better for those two companies to merge or for Tesla just to crush GM. But make no doubt about it, GM's in trouble. The recent labor negotiations point that out. So if you are one of those people who thinks GM is a value stock, I got news for you. It'll be a better value stock when it's down 50%, because that's what's going to happen. It might even go bankrupt again. So the solar panel here from Musk and from Tesla took them 2 years to finally get it ready. And everybody's like, it's not coming, it's not coming. That Buffalo plant is ramping up. It's coming. And the prices are going down. So much, in fact, that last week, Musk lowered the price of batteries by $1,000 to help them. Think about that as a lost leader. I thought this was funny. To prove how strong this was, and this is a thought that I had, because I live in a part of the country that gets hail from time to time. Can this solar glass survive, something hitting it? So he smashed a pumpkin on it, which I thought was pretty entertaining. See if we can... Granted, that's not as hard as hail would hit, but it still makes a point. They say that hail the size of a softball can hit it. More on Tesla. Go to Bloomberg and take a look at their Tesla Model 3 survey. It's pretty encouraging. But again, it shows the transition, the nature of change, and the lumpiness, the ups and the downs. If you believe that something's going to be a big deal 5, 6, 7, 8 years from now, use the short-term fluctuations and the doubters and the people who are trying to trade and the bouts of negativity to accumulate your shares to be a long-term hold. Now, I've basically said that Tesla under 200 is an automatic buy. We've had those opportunities twice. I know a few of you own shares. I sold it up around 340 last time, and we are getting to that range again, I think. $311, so it was a little higher. So if we got back down into here, excuse me, even the middle 200s, I think you have to think about buying it again. Will we ever see Tesla under 200 again? I'm not so sure. I don't know. Maybe. But man, if we got one of these again, I'd for sure load up on it. Had you bought down here around 180, you made 50%. More than 50%. I'm going to be writing a series of articles on Tesla because I think that is just such a statement that company's making on the future of the world. Whether they're the company that benefits or not, still to be seen. But I think it'll be one of them. Their market share, I was just at Potawatomi Casino. Somebody quit my service and said they can't listen to a gambler. Yeah, whatever. I don't care. But one of the things that I see, I park over by the electric vehicles to see how many are there, and there's a lot of Teslas there. Some Nissan Leafs, but it's mainly Tesla Model 3s, and somebody has a Model S. I have not seen a Model X yet, and the Model X is the one that I would love if I could, justify spending $100,000 on a car. For those of you who think that nuclear has a role in the future of the world, you're wrong. It doesn't. Why? Because nobody wants it, and the technology is just so far away yet that even Bill Gates throwing tens and tens of millions of dollars at the small nuclear, it's not even close to being there yet. There's just still too much waste. So it's one thing to put it on a submarine, which if it sinks, it's at the bottom of the ocean. And they can, and you're just powering a submarine, so the waste is manageable. Try doing that for the entire grid. Can't be done. So nuclear, maybe someday they figure it out and they can take the theory, which is that you can have a small nuclear power plant that basically produces almost no nuclear waste, and the waste that it does produce is not that terribly radioactive. They can be shielded with water. We'll see if that happens in our lifetime or not. The direction of the learning curve of the manufacturing, the ideas there are so slow. It's not like Moore's law with semiconductors and something approaching Moore's law, like with alternative energy, solar in particular, and batteries. There's not a great curve of advancement with nuclear. The ideas are there. They haven't figured them out. Now, could there be a surprise breakthrough someday? Sure. But I think what they're figuring out is that it's way harder than they had supposed. I've told you that there's this big marketing push in the financial industry to go after sustainable investing, ESG investing, and to target millennial investors. That wave isn't done yet. I suspect that we'll get to a point where around half of financial people actually, brand themselves as sustainable investors. I've been branding myself on a light scale as sustainable, but I want it to be normal. This idea that you're going to completely mix ideology and what you want to happen with your investing versus what you think will happen is dangerous. People will get out over their skis. I did it with oil. Now, it wasn't really an ideological belief with me on oil. I just thought that there was a big bull market coming under Trump and in the early 2020s, and then it would peter out. We haven't gotten that bull market yet. The bull market in oil coming, and it is coming, probably will be shorter and steeper, but maybe not as big, right? So a smaller hill that you have to climb more vertically. We'll see. But a lot of things are driving the direction of energy investing right now. And this is one of them, the financial industry looking for a buck. So let's take a look at SunPower. SunPower is one of the companies that I've said could be a 10-bagger. I've actually, I guess, a 20-bagger because we were buying it at 567. I said that I think it'll get to 100 at some point. The misconceptions about SunPower were a couple of years ago that they had too much debt. And I said, no, they can restructure. And by the way, Total is the majority owner, so that's always the backstop. In the last couple of years, they've dramatically reduced their debt. Their revenues are increasing, and they are very tied to California. The opportunities for SunPower are so big that I would double down here and say I almost think that this could end up being the best stock I've ever owned. And remember, I was buying Exact Sciences between 2 and 20, and it went up over 100 recently. It's pulled back since for the same reasons that I said it would pull back when I told people to sell in the 70s. And I don't know that it's all the way back down to the 70s, but it was getting close the other day. So what I talked about with SunPower was that they were commercial leaders, but now they're starting to book residential. Record number. The ramp up in residential in California is going to be pretty steep. Why? Because there's a law that says that you have to have it for all new constructions. SunPower is one of those companies that will benefit. That was just easy reading. Agriculture is one of the things I focus on. So sun power here. Take a look at the chart. Maximum pessimism. It's when I got real interested. We really started buying it last year. Ran up. Now it came down. And it's in a choppy range now, right? That looks like consolidation. Daily chart. MACD looks like it might be bottoming out. Money flow bottoming out. Oversold. What does the weekly say? I think the weekly, right? The inclination is to say that you think it's going to keep going down. Maybe, right? It's already about at the level where it broke out last time. Resistance becomes support. I don't think there's a lot of downside left in sun power. Monthly, right? They just took their digger. I think that weekly is support in the next week or two or three, short term, within a month. So sometime in the next month, I think you want to be a buyer of sun power. We've been selling the puts. You sell $8 and $9 puts, depending on what your risk tolerance is. So somebody asked, why sun power cut in half recently then? Well, what did I just say? These markets are choppy. There's people who get emotional. There's traders who push things up and down. Right? Got your trickle out of money. Approaching support levels. Right? That's support. So resistance, resistance, resistance breaks out. Now it's coming back down to the old resistance, which is now support. And if you see the monthly, it dove off a cliff. This is all indicative of consolidation after a pullback. Filled its gaps. Classic. And now look at it. So unless something bad happens, it's probably going to be in the eight-ish. And you should be trickling in. Now, take a look at our bottom feeding prices. Right? Bullish support was 11. They went through it. So it could go all the way down to 6. Seen here in 6s. You want to decide where you want to buy. Do you own 0 of it? I'd be selling puts. And I'd probably take maybe a 1% position. If you already own some, I'd probably only be selling puts. Probably the 8s. Take a look at Zacks has it in the middle right now. And I think that might last, like I said, for about a month. All Zacks is telling you what it aggregates analyst opinions. The analysts are on the fence right now. So we'll take a look at First Solar, which is also pulled back. Right? A lot of this has to do with what I showed you with China slowing down on their solar. Sun Power might go down with a big stock market decline. Somebody brought that up. However, what if the next stock market decline has to do with rising energy prices as the last catalyst? Right? I mean, that's important to remember. Most recessions and economic slowdowns, the last catalyst was rising energy prices. over and over and over again. Pretty much every recession we've had since World War II, I think actually since the Great Depression, saw energy prices rise right before the recession started. So the traders, if you follow some of the people that I follow on Twitter, some of those traders are really good, and they're starting to close out their short positions on energy, and they're starting to take long positions in energy. So with First Solar, we see that it's tipping over, and this looks like a retracement, right? A smaller version of these. So these big moves are now replicating, but in smaller scale. That's very bullish. That is reminiscent of something that's just going through a consolidation. So one of the technical guys that I subscribe to is a guy named Zach. He's over at Elliott Wave Trader, and he does these charts which show the ranges of where First Solar could be. His actually looks like it goes down to 39.84. It's kind of a floor price. But this is the one that he's focusing on. That's where his little C is. So 46 to 50 is his numbers. And these are never going to be perfect, right? Technical analysis lays out a higher probability, a lower probability, and a holy cow, I guess that could happen too. There's usually 3 or 4 outcomes that in rank order of probability is what technical analysis is telling you. I use the money flows on top of that, and I actually prefer the money flows because I think that those help us find the pivots better, but this helps us to find the ranges. So First Solar is looking incredibly bullish, right? Go back to that chart. It has all these big moves in here after the plunge, which was back in 2011. And big moves. But then look at this box. That just, it's consolidating into a tighter range. So either First Solar goes to hell because it's going to go out of business, then it falls off a cliff, or it has a future, in which case it's starting to get spring-loaded like a rubber band. Look at the range of potential on this out for 5 years. I mean, his upper band is up around $500 a share, $536 a share. I don't know how I feel about that, but I think the general direction is up, and it'll be way up ahead of the markets. So if you can buy it on these pullbacks, somewhere between 40 and 50, low 50s to low 40s is what I'm thinking, and then you hold it for 5 years, and it goes to 160, you triple your money in 5 years. These are the types of investments you have to find. Everything's on their side. Technology, legislation, finances. These guys are essentially debt-free. They're profitable in some quarters. They're on the verge of big profitability, I believe. First Solar, I think, is right, almost right where we want it. It's oversold, right, on the dailies, on the weeklies, right? Looks like it's hitting some support here. Take a look. Broke through that level, came back down, holding it. And it's almost oversold on the weekly. This came down. Looks like it's about to turn back up. Again, it looks like we're within a month of these solar stocks heading back up. Now, that might be a little bit indicative of the entire market as well. Monthly had their digger. I think you should be looking at First Solar right now over the next few weeks. Sunrun is a company that I'm adding. to the very short list. I have not done all the analysis, but the one thing I'll tell you about Sunrun is that they're big in California, and Costco is working with them. And Costco doesn't pick out chumps. So when Costco makes an offer to their members, says, hey, if you're going to go solar, take a look at this. I can tell you something. A lot of Costco members are going to look at this. So Sunrun is very interesting to me. Again, I like that pattern right in here. So I don't know if it can go back down under $10 a share again or not. Maybe. But I'm thinking I'll probably take a 1% position to get started and maybe sell some puts soon. Enphase Energy has fallen off a cliff. Zacks has all the analysts lined up. The analysts are saying that the earnings are just going to keep getting better. Take a look at the short-term chart here. Let's just take a look. Let's make it easier to look at. Just coming off a super oversold. I believe it got beat up yesterday. Yeah, was it yesterday it fell off the cliff after earnings? Gaps like that down, you usually have to wait a little bit to see if there's another drop down. So I'm not too excited about this just yet. And I might live to regret it. You know, bullish support at 20. So if we're in a bull market, which I don't think we are anymore, 20-ish is actually a spot to buy. But I do think it could head all the way back down to 12. And I'm in my scaredy cat mode. So I don't know that I will buy it unless it gets down into this range. Or unless we see real good reasons why it's going to hold in this range, right? But right now, I'd be targeting 12-ish to be a buyer. The drop from 19 to 12 is pretty big, right? It's 30+%. I don't know that I want to take that risk just yet, given that we know it's still a transitional market and it's going to be choppy. Costco is always too expensive. Have they pulled back? Somebody mentioned Costco. It's a symbol for them. Cost. Duh. Yeah, Costco's always hard to buy. I think Costco down in this area, maybe, and for sure. Yeah, Costco's way too expensive. Very slow growth, and it's not going to get any faster. Sunrun's going to be one of those companies that help it keep some growth rate. I have studied Costco though. What they're doing with their chickens is amazing to me. You know, they're vertically integrating. They're gonna have their own chicken farming. I think it's in Nebraska, right near the Iowa border. Is they're gonna build one of the biggest chicken I don't know what you call it, but where chickens are raised, chicken farm in the world. Solar Edge, again, you wonder about this. Is that an irrational exuberance, this gap? Yeah, I worry about this stock. I would have a hard time buying it above 70. First support I have at 53. Man, there's an argument for me to change that to 70-ish, but right here is right in here. This makes a lot more sense to me. So I don't know. Maybe I need to study the technology again. But I think Enphase is probably the better technology. So that is something to keep in mind. Generac, completely whiffed on this one. I was talking about it a year ago. I didn't buy it, and the thing went off to the races. I don't know when this comes back. Now, this is for two reasons. One, the generators. Everybody knew that they were going to need generators in California. We should have just bought on that. But now they're starting to get into to compete with Solar Edge and Enphase at some level in the next few years. So Generac is one that I think, after I review the numbers, this is the one that worries me, is the debt. If these guys would pull back down to that end of last year price in the 70s, I think we'd be kind of silly. Oh, actually, I take that back. That's not the 1 year chart. But I think that right in here in these 70s is where it pulls back to. Could it pull all the way back here or all the way back here to the 40s and 50s? It could. You know, then it becomes a no-brainer, right? Then it's an easy decision. But I think this growth is legit. Now, how much of this can be attributed to short-term generator sales that are going to come back? I don't know. That's what I have to figure out. So it's not impossible for us to come back into the 40s. 70s makes more sense to me, but we'll see. Do Tesla here real quick. Again, let's do this here. Tesla gapped up here, probably fill the gap at some point. So again, right in here is where I'm looking to buy Tesla, middle 200s. And if we get one of these, then I'll buy more. This company is intermittently profitable, and they're taking massive market share, and they're expanding into growing markets, and where they're essentially a leader in EVs, and I think they'll ultimately be a leader in solar. Their solar package is the most attractive one out there. Now, other companies are going to put together things that are pretty as well at some point. But, you know, this is a company that has navigated a very difficult path with a lot of criticism and a lot of people trying to sabotage them along the way, to the point where somebody sent spies into the company and disruptors and saboteurs. Think about how disruptive this company is to gas and to oil and to other auto companies. And then think about, how did saboteurs get into this company? It's not a big leap to think somebody's trying to make them fail. It's not a big leap that a lot of these people are writing about how difficult their finances are, ignoring the fact that some of the biggest wealth funds in the world want this company to succeed and keep investing in them. You know, I'm skeptical of Tesla bears. I think that the little guys who are buying into it because there's people out there telling them to buy into it that aren't really providing legitimate analysis. It's bought and paid for stuff. I think you buy it here. I think you buy it here. And I'm pretty sure I'm going to raise. Well, no, that's about right. So middle 200s and then below 200 are 2 buy points. And I just want to point out, scaling in doesn't mean every time it goes down 2%. You find your technical ranges, middle 200s, 180-ish. Those are the spots you buy. You don't buy at 250 and 240 and 230 and 220 and 210. And oh my God, I'm out of money and I feel bad about this, so I'm not going to buy it at 170. Bigger gaps in your scale spots. All right, and we'll finish up with, I have to do research on Bloom Energy. It's an interesting idea. The solar ETF. So years ago on Market Watch, I wrote that this ETF had too much China exposure. They fixed it. So now it's much more American in the 20, but it's a concentrated portfolio, right? 25 stocks. Solar Edge, First Solar, Sunrun, and Phase. For the top 5 holdings we just talked about. SunPower's down here. I think that'll grow. Vivint is an interesting company. Canadian Solar is, by Chinese, partially Chinese. They have a couple of the yields in here, yielders. So this actually has a dividend yield, I think, of about 1.5%. Oh, 0.5%. Okay. In any case, go through the technicals. And this is something that will go into, I have an announcement, by the way, into the Global Trends ETF model portfolio. Anybody catch that? All right, so where is the support on here? Right, resistance becomes support. So it's real close. It's almost oversold. Again, all these charts look kind of similar. I think this is something that we buy here ahead of the Santa Claus rally. Now, if you want to just hold it forever, go ahead. But if things get dicey in January and we're up 10 or 15% in a couple of months, might take the profits. But I think that this is a fund that you want to own long-term at some point. Big crash, 2011. Waviness, consolidation. Look, a narrower range, but with an upward bias. Some point, you're going to get this big ramp up again to get back to these levels. So it's 28. So do you split hairs and say, well, I'm going to wait till it's 22 to buy it? It's probably going to 100 in the next 5, 6, 7 years. All right. So what is the announcement? I am going to start doing model portfolios. I know everybody's been bugging me for that for 2 years. I'm going to do it, and I'm going to make it consistent across platforms and with my firm. So there will be 4 model portfolios: Global Trends ETF, Sustainable Growth Investing, which is a pure alpha play, Retirement Growth and Income, and then essentially Retirement Growth and Income with option selling. And that one will be called Retirement Income Options. So those are the 4 core portfolios. Now you can piece them together however you want. You might want to put half of your money in the Global Trends ETF and then be a growth investor if you're a millennial. Or you might want to be just 100% in growth and income stocks with a little bit of ETF core. So you'll have to pick how you want to incorporate those, but I will have those up by Sunday and Sunday night for sure. So you can all see them on Monday, and I will update them every month. Volatility trade. So I had a chart. Let me grab the chart for you. Actually, it's in the article. So I didn't exactly pound the table on this because I talked about, where's it? Where's the other chart? I'll put it somewhere. I don't know where I put that chart. Oh, sorry about that. So in any case, we'll pull this up here. Just look at it over 1 year. There's no point in going back on this more than 1 year. We know that there's perpetual deterioration in this because they have to roll the futures every month, right? So this chart will chronically go down forever, and then you get the pop-ups. So look at it over 1 year. You take a look here, and then you take a look at VIX. So you measure the VIX index. Good grief. This is something somebody just asked about. We measure the VIX index, right? This doesn't deteriorate. Somebody told me that there's some deterioration in this. That's how I knew they didn't know what they were talking about. I didn't want to argue with them. There is no deterioration in this index. It's just the index. The ETF, ETN, that follows it deteriorates because it has to keep buying new futures on this index. So we know that when it gets down to 12-ish, it's generally a buy. And sometimes it gets down to 10-ish, and then it's a screaming buy. So in the last there you go, on 3 years. In the last 3 years, the floor has slowly gone higher. So I had a chart where I showed that there was a little bit of a tilt. And if it broke through some support, which appears to be going on today, then it probably becomes a pretty big deal to buy. So if you haven't gotten into this yet, you might want to sell puts on it today. You're gonna get a huge premium. Let's take a look here. All the way down to 19. So my puts might get put to me. I'm fine with that. So if you sell December's, like 17 or 16, you get some premium in here. You can be more aggressive. If you're going to be more aggressive, go shorter term because you don't want to cross the roll dates. 18.5, right? So if you're selling these, man, these premiums aren't as good as I thought. If you're going to sell these, it's because you want to own this. I'm not excited about it right now. We're getting close. And if you really want to do a very short-term trade for a few weeks, I think you can sell these puts right there. But it's not an easy trade, which probably means it's a good trade. So again, this is just small hedging of the portfolio if you're sitting on a lot of cash. Do you need a large cash position to sell? Well, you need enough cash to cover buying it, right? And you don't want to go more than a few percent commitments in your portfolio because this isn't a screaming buy right now. This isn't a screaming good investment. It's just pretty good. So if you think that the market's choppy in the next several weeks, go ahead and sell these puts. If you only want to stick with great setups, this is not a great setup, as I said, this is just a good setup, avoid it. Wait until it becomes a great setup. I'm pretty sure if I sell a cash secured put, I'm always willing to own it. You never, ever, ever sell it. And we've been through this. I even put it in the article of, don't sell options, don't trade options until you read this. If you sell cash secured puts, you have to be comfortable buying the stock, period. So as far as the time decay goes, because of the time frames we're looking at, yeah, I'm willing to buy this. Now, does that mean it's my, would I rather just have this expire and keep the premium? Yeah, pretty much. And then wait for the great setup? Yeah. But this is a good setup. So you have to decide what your risk tolerance is. Is it enough money for you to take this risk? So you guys like the so Ted is so Dividend Sleuth. I asked him to work on all the Brookfield Asset Management ETFs, or excuse me, REITs. I think that Brookfield Asset Management is an awesome company. I think it's overvalued right now, like most real estate. But I think the people chasing the higher yields of their sibling, of their subsidiary REITs, are making a mistake. I think that they should be looking at, and I want to see what Ted comes up with. I might be wrong, but I think that the terms that the parent company gets, even though they pay a smaller dividend, is better for long-term total return than trying to capture the cash flow, right? You're getting charged. Brookfield Asset Management charges you a fee to get a higher dividend yield on any of their other REITs. They take a VIG. So in the long run, is it better for you to have a higher total return, or to be able to say, hey, my dividend's 7%? Think about that. And let's see here. Thoughts on calls. I am not ready to buy calls on VIX. Occidental's dividend yield is currently 8%. Do you see any risk to its dividend? No. I think Occidental is one of the big long-term winners in energy. They have the right business mix. And that's what it comes down to. What is their business? Study the business. The CO2 business, them edging into solar, right? Them selling off most of their other assets other than Texas. Yeah. I like Occidental. I still like CenturyLink. Again, another company in transition. If you take the time to understand the companies, then transition doesn't scare you so much. People are terrified of change. Terrified. That's why so many of them stay in shitty marriages. Change is where opportunity is. So I'm not saying if you're in a shitty marriage, get divorced. I'm not going to go that far. Probably that's good advice. Change is where opportunity is, because change scares people. And what do we know about being scared? It crushes prices. Right? So if you know something is good, but it scares people, buy it. Blood in the streets. Buy fear, sell greed. Buy high, sell low. Oh, said it backwards there, didn't I? Buy low, sell high. Greed pushes things too high. Fear pushes things too low. If you can try to recognize that, you're going to be an amazing investor. All right, I'm going to let you go. Have a great weekend. If Hamilton comes to your town, or you're in a town with Hamilton and you can get affordable tickets, I once again, I was shocked at how good it was. I didn't expect it to be what it was. Don't check it out on YouTube ahead of time. Let yourself be surprised. So, has anybody on this call been to Hamilton? Nobody? That's so sad. Yes, great. Okay. All right. Is there any other questions before we call it a day? You guys, you pretty much universally like the model portfolio thing? Yeah. Okay. All right. And for any of you who are on fundamental trends and you left margin of safety investing, just remember to hit me up on the dual citizenship special. And if any of you want more regular swing trading and you're in margin of safety, but you want the swing trading, like I said, I have a dual citizenship thing where I will give you a super incredible discount on fundamental trends. So you can have the stock swing trading, which should be kicking into high gear here in the coming weeks. All right. Everybody have a great day.